I think it's probably quite a good time to start now. So just to give everybody a warm welcome this morning, although I'm sitting in a cold conference room, I trust that everybody's keeping warm today. Thank you for taking the time out of your day to join us this morning. The webinar that you've joined is Selling Your Business. And what we want to challenge you about is, are you thinking far enough ahead? So just to give everybody a very warm welcome this morning, thank you for joining us and thank you for taking the time. Next slide, please. So just to introduce ourselves this morning, as we commence this webinar, I think it's appropriate for us just to tell you a couple of things about Menzies. So we are a leading firm of accountants and business advisors in the UK, and we are part of a large international network, which gives us terrific reach on a worldwide basis. We're a partner-led practice, and we have 45 partners, and we have over 600 members of staff, and we have a number of different sector specialisms. So in talking about selling your business, we have a range of experience across a range of different sectors, and we're looking forward to this morning. So next slide, please. I guess the key question you've all got is, well, how do you sell a business? So if we answer that question, the first thing obviously is that you find a buyer. The second thing obviously then is that the buyer makes plenty of inquiries and kind of makes sure they understand what they're buying. So you go through a due diligence process, and then you need to document what you've agreed, which, you know, is all pretty simple really, isn't it? And that's having agreed a price. Sounds really easy, doesn't it? Find a buyer, help the buyer to make sure they fully understand the business, and then document the agreement. Nice and simple. So that's how you sell a business. But what are my exit options? Well, there's lots of jargon involved in exit options. Obviously, there is the opportunity to float onto a stock market if your business is of the right size and scale, although that's harder recently than it has been for a while. But there's a range of other options, from selling to your management team, from selling to private equity, from a trade sale. Now, we're not particularly going to focus on the different options this morning. We're going to talk generically about selling your business. And I guess the background for this to a large degree is kind of how a trade sale tends to operate. Next slide, please. So selling your business kind of comes into three elements, really. And we're going to unpack these as we go through the webinar this morning. The first of which is preparation. So it's fine saying it's about finding a buyer, going through a diligence process and then documenting it. But you've got to prepare for that. And clearly, to get the price that you want, you need to kind of optimize the business to be able to get that price. And then we're going to talk to you about the whole process of, well, how do I actually sell my business? Because you've simplified it really by just saying find a buyer, go through a diligence process. But what does that really mean? And then we're going to take time as well just to talk through that final piece of the process, which obviously is realizing the value and enjoying the proceeds. But maybe the question is that we should be asking you this morning is, well, why are you selling? It could be that you're selling because you want to retire. You're dreaming of that boat or the time on the beach, and you want to retire and actually put your feet up, having successfully run the business for a number of years. It could be that what you actually want to do is to invest into another business or to invest into property, and therefore the reason you want to sell is because you're looking to reinvest into something else. Or alternatively, you could simply be looking to reduce your risk, because at the moment all your eggs are in one basket. You're running your business, and it is successful, but actually you've realized that all your money is tied up in that business, and it's your primary asset, and you want to de-risk to move things forward. Next slide, please. So in selling your business, what that really means is that you're going to have some key objectives. You're going to want to maximize the value in coming to sell your business, to fund your retirement, to enable you to reinvest, or simply to reduce your risk. But at the same time, obviously, what is going to be important is that you keep running the business. And what's really important, therefore, is that you minimize the time and disruption involved in selling the business, because whoever buys the business needs to be able to continue to run the business. So maximizing value is all about presenting the company as effectively as you possibly can. And obviously minimizing the time disruption of a process, and we will talk about a process and a typical process, comes back to that adequate planning and preparation. So this morning's webinar really is all about making sure that you are thinking far enough ahead. Now, we're going to pick up questions as we get to the end. So if you have any questions, please drop them into the Q&A at the bottom of your screen. But we're also now just going to ask you a poll, and take a poll across you just to find out what you're all thinking this morning, and to share those thoughts with one another. So if we could please release the first poll. So the question we want to ask you now, and if you could answer, please, is we'd like to understand what time frame are you looking to sell in? And you'll see that we've got some answers there. And we're just going to run the poll now for 30 seconds or so, just to see where people are. Interesting, isn't it? I think there's probably a timing thing here as well, that if we ask this same question just ahead of an election, you probably get different outcomes. If you ask this question just before there's about to be some big tax changes, you probably get different answers again. And of course, this all comes back to kind of making sure that we plan well in advance. Okay, so the answer to our question, if you could publish the results for me, please. So we have, at the moment, our answer to our question is 2 to 5 years is the majority of people attending the webinar this morning. So that's interesting. So if we could close the poll now, please. Thank you. Could we come to the next slide, please? So the next question in your mind might be then, well, how long does it take for me to sell my business? Of course, the answer is a great answer from accountants, isn't it? It depends. It depends. I guess the key question is, has someone approached you? Because that's how a good number of sales have been taking place over the last few years, that the business has had an approach. But of course, are you ready is the key thing we want to talk about this morning. Or are you approaching somebody else? And if you are, then clearly that takes some planning and preparation to be able to make that approach. Next slide, please. So how long does it really take? Well, I guess really the answer to the question in terms of the process is the process itself can take somewhere between 9 and 12 months. Now, that includes a significant amount of time for kind of preparation and target research and moving things along. But of course, what it also needs to take into account is that it's not just about the point at which you finally sell, because even after you've sold, there can be value for you still to achieve through an earnout and through deferred consideration. But of course, what this does require then is for you to be ready to be able to sell and to be able to go through that process, which is all about the preparation. So if we come to our next slide. So to give you some kind of an idea of a timeline, we've prepared a typical process here. We've based this on 9 months rather than 9 to 12 months. And obviously what's possible as you look at this timetable is that elements of the timetable can be accelerated or elements of the timetable can be slowed down. And that's important for us to be able to focus on. But we want to ask you, are you thinking far enough ahead? That's the question this morning. So if we come to the next slide. So let me say to you, how do you value the business? Now, there's more than one way to do this. The first way, obviously, is looking at the asset value. So thinking about your balance sheet value. and thinking about, is that the value of the business? And that's a good starting point, but the problem with that is it doesn't actually recognize any value for goodwill. And therefore, how might you value the goodwill? Well, you may end up just putting your finger in the air and coming up with a number. Not perhaps the best way. It does work for some businesses to think about the underlying asset value, but for most, it's not the most appropriate method. The second method is more complex because it focuses on cash flow, and you've obviously have the phrase that gets used is discounted cash flow, which is a complex mechanism for understanding the value today of cash being generated in the future. And that is great if you have a steady, sustainable, stable business, perhaps with long-term contracts. And really, large corporates tend to use discounted cash flows to be able to understand the return on investment. But for the typical small, medium-sized enterprise with cash flows that move up and down and profitability that is variable, it's not necessarily the best way to value the business. So the established method in the market for SMEs is a multiple of the profits. But let's just unpack that a little bit further, because multiple of what profits and what multiple are obviously the two key questions that follow on from that. So if we come to the next slide. So we've got quite a complex slide here. And it really helps us just to understand that we're focused on a multiple of profits, and a multiple of profits will help us to work out the enterprise value. And that is so that you've got a comparable basis from business to business at any particular time. And the key thing here is that it's the profits of the business, and depending on the circumstance of the business as to whether that's the earnings before interest and tax, i.e. before depreciation and amortization, or after depreciation and amortization. So, and that depends on the assets that are required to run the business and whether one needs to make an adjustment for regular capital expenditure. So it's the profits in the business, but the profits may still need to have an adjustment made to them because perhaps there's some one-off non-recurring items that have gone through the business in the last couple of years. And what is important in relation to value is the underlying profitability of the business. Now, we're showing you a typical multiple here of, say, 3 to 6 times, which is very much the value of an SME. But of course, there are exceptions to that rule. If you think about software businesses, they tend to have much higher growth, they tend to make much higher returns, and as a consequence of that, they can be valued at much higher multiples. But that gives us initially a multiple of the profits, the enterprise value, but that doesn't necessarily give us the value of your shares. So there's another set of adjustments that need to be made. If we come to the next slide, please. The adjustments we then need to make to the business, having established the business value, businesses are sold typically on a debt-free, cash-free basis. And to be able to establish what is the surplus cash available within the business, one needs to look for a normal level of working capital to be within the business. Now, of course, if you have a business where you've literally just had to bring in extra stock because of the growth that you've got, the chances are that your working capital is much higher, and therefore that could add an additional contribution to the business. So net working capital is another adjustment. So the cash, the debt, will then give us the share value or the equity value. So if we come to the next slide. So how do you know if you're ready? So the key things in thinking about are you ready are the trading performance of the business. Well, we said that we wanted to maximize value. Then clearly kind of what that performance is going to be really important. And the future prospects, because let's remember, and we'll see this in a moment, it's really important to remember that the buyer is looking to kind of what the business can achieve in the future rather than what the business has done in the past. So the trading performance and the future prospects drive the price. But then what you also need to remember is that your contracts and your financials and the whole kind of documentation of the legal position enable the process to happen. So therefore, having a tidy position across the whole of the business is what will enable you to complete a transaction. So are you ready? But how do we optimize the business? If we come to the next slide. the way to optimize the business is to identify, obviously, the key value drivers in your business, and to understand what buyers want, and then to focus on optimizing your business as part of the preparation. So if we come to the next slide, this is the value equation. Our Menzies advisory team support our clients in ensuring that they focus on the value equation. And the value equation is about driving up the maintainable profits within the business and at the same time driving out the risk. Because remember, if you're coming to buy a business, what's going to kind of make you nervous as a buyer is seeing a risk that you think you can't totally control. And the way you're going to adjust for that is to pay less for the business. And obviously, as an owner of the business, as the vendor, if you can address that risk and reduce that risk, then you are making your business that much more attractive to the buyer. And what that means, as we can see in the right-hand side of the slide here, is that will increase the capital value of your business. And at the same time, as you go along, it will increase the rewards that you can generate from the business. So what are those primary value drivers? We come to the next slide. Clearly, the primary value drivers across any given business are the strength of the management team. And I don't mean you as the owner of the business, I mean those around you, your second tier. The ability for you to be able to report on your financial position, and indeed the fact that financial reporting information is robust, that it's produced timely, potentially that it also includes the appropriate key performance indicators so that you know when the business is doing well and how well the business is doing. A good spread of customers. Just think about risk. If you had all of your business, all of your eggs in one basket, you've got one absolutely key customer that was 95% of your business, the buyer would probably have a view that was a high risk. So therefore, you do need a good spread of customers. The visibility of your earnings, the ability to grow the business is really important. And of course, having a clear strategic plan in terms of where have you come from as a business and where are you going to, and therefore where the developments are that will stand behind that growth is really important. And then ensuring that you have all of the appropriate legal documentation in place. So we come to the next slide. So what are the risks? The risks, really, to focus on driving out the risks, you need to do some advanced due diligence yourself and think about your business from putting your feet in the shoes of a buyer. Are you compliant fully with the regulations that govern your sector? Or are there areas that you need to address? Where are you with your customers? Do you have customer agreements? What are those agreements like? When did you last revisit them? Where are you with your suppliers? Do you have alternative lines of supply? Where are you with your people? What about your trading? What about the financials? And it's really important for us not to overlook cybersecurity, because cybersecurity is an increasing issue for all of us. And therefore, being comfortable with your IT systems, everything surrounding security is another important area. Next slide, please. So what do buyers want? Think about, again, putting your feet in the shoes of a buyer. The buyer is obviously keen on the opportunity that you have within the market. So your market positioning is important to understand. Understanding that there is a growth opportunity in your business is important for a buyer. Understanding that when you come to sell and as you're exiting the business, that there is appropriate management succession around you to be able to keep the business going so that they can generate value into the future. And really understanding the clear strategy that you have. And for them, it's a case of understanding how that aligns with their strategy. So just picking up that growth point, if we come to the next slide. Yes, let's not forget this. Leave something for the buyer. The key thing is that people buy the future, not the past. The past sure gives an indication as to what the future might be, and growth therefore is important. But imagine if you'd reached the point where the business was just about to plateau, then I'm sure you can imagine that it would be less attractive to buyers than a business that still has growth to come. So the optimal point to sell your business is the point at which you've got further growth to come through. So we come to the next slide, please. Just thinking about your people and succession. The key thing here is to focus on the capabilities across your team, ensure that your second tier can step up, Think about whether you do need to tie them in. Now, our tax team would be only too pleased to help you in thinking through tax incentives through the EMI scheme and other opportunities that there are to grant options, etc. And obviously, what you may be doing by thinking far enough ahead is realizing that there's a bit of work to do on this, and therefore there's training and development that you need to to provide to your second tier. But what are we trying to achieve from that? We're trying to achieve a reduced dependence on you as the owner of the business. Again, reducing the risk. Because remember, the value equation is increasing maintainable profits, reducing risk. And that's what's going to increase the capital value of your business and enable you to achieve rewards. So let's just think about strategy for a moment. The journey, that's the best way to think about this. It's where are you now, but where are you going to get to? So it's fine being able to present some projections that show growth, and we've already looked at the optimum time to sell, but knowing how you're going to underpin that growth and what that journey is going to be. So what are the objectives? How are you going to benchmark it? Where are you to move things forward? Can you therefore check to make sure you're on track? And then obviously bringing management accountability. But the vision, of course, can be linked back to the value. Because if you want to retire and the boat is a bigger boat that you have in mind, or the beach is a better beach further away in more sunshine, then it could be that you need a greater value to be within the business, and therefore your vision needs to be clearly documented. Now, this morning, we are going to be launching a white paper, and I'll come back to that a little bit later on. But it included as part of that white paper will be the Menzies Business Optimization Checklist that basically just gives you the areas to think through to make sure that you are planning far enough ahead. Now, I'm going to pass across to Tabitha, one of my colleagues in the corporate finance team, to talk us through the process. Thank you, Tabitha.
Thank you, John. So just to recap on the process itself, so generally this would start off with preparing what we'd call an information memorandum, an IM, which effectively presents the business to potential parties. You then go to market and discuss and present the business to potential buyers, and then get offers and agree heads of terms with the right buyer. Then go through a period of due diligence before finally agreeing the contracts, and at which point you can complete the deal and then realise your value. So let's just break down this into a little bit more detail. So phase one, we like to call presentation. So this is where you are preparing to sell your business, and we would often see that this takes we'd normally allow about 2 to 3 months for this process. So what's involved? So firstly, the IM. Now this needs to be confidential. This is vital. So this ensures that all the sensitive information is kept confidential. And this is really important when preparing the IM. And what is sensitive is going to vary from business to business, but may include customer and supplier names, details of employees and your IP, etc. And the purpose of it is to present the business in a way which is going to maximize the value and ultimately enable somebody to look at the business, value it, and put forward an offer. And it also may support a purchaser by allowing them to go and raise funding to enable the transaction. So it fulfills several different functions. Now, during this preparation phase, you might also want to identify risks that a buyer might see, or risks to the transaction itself. So we're going to anticipate due diligence and anticipate any issues that might arise during due diligence. Now, at this point, you might want to present those, and that needs to be factually correct in the way you do it, and then balance them by highlighting strengths in the business as well. During this phase, often we'd be doing research to identify who might want to buy the business, who are the potential purchasers. Now, best way is to focus on those who are credible buyers, and this would be buyers who have the ability to fund the transaction, and that will help to minimise the risk of a deal running into problems at a later stage. In addition, you probably should consider what a buyer can bring to the table, and assist the business with the growth strategy that you've already set out and put together. So identifying the right buyers who can support that growth strategy can really help to maximise your value. Your advisor will also have networks of interested parties, which could extend that pool of suitable purchasers. Again, remember that confidentiality is really important when considering the suitable buyers, and this will help to minimise any negative impact on the business. So depending on the business, it may be needed to exclude any direct competitors, but non-disclosure agreements or NDAs will be needed before approaching any interested parties and sharing any information with them. So on to the next phase, so finding your buyer. They would normally say that this would take between 3 and 6 months, but it can be shorter if all the parties are really motivated and focused on getting and agreeing terms. So what's involved here? So go to market. So this is where the IM's been prepared and approach a pool of suitable purchasers and share the information with them. Now, again, nothing should be shared without NDAs, as confidentiality is really important. So after reviewing the IM, the purchasers will then submit their offers based on their valuation of the business. And an offer should include all the key terms, including the structure of the transaction, any assumptions and conditions that the buyer would require, and the timescales that the party should work towards. And it's important to consider all of the key terms when reviewing offers and not just looking at the headline price. Now, once a preferred buyer has been chosen, time to negotiate the value and the key elements of that offer. And then once an agreed offer is in place, it can set out those key terms in a heads of terms or a letter of intent. And whilst most of these agreements are not legally binding, it will help to ensure that all the parties are clear on the broad terms and how the rest of the process will proceed, including what the expected timescales are. And that really helps to make sure everybody is on the same page at the outset. Okay, moving on to phase 3. So this is due diligence and execution. Depending on the complexity of the transaction, we'd often expect this stage to take between 8 and 12 weeks. But again, that timescale can be compressed and accelerated if all the parties are prepared and focused on getting it done. So what's involved in due diligence? Now, this is a really resource-intensive stage. Now, preparing for due diligence often requires a lot of input from the shareholders and key members of the senior team. So any preparation you can do beforehand in the lead up to the transaction will be extremely beneficial during this stage. It often involves providing hundreds and hundreds of documents and pieces of information across all the areas of the business: financial, tax, commercial, employees and HR, technology and IP, if that's relevant, and of course, legal. Now, onto execution, once the due diligence has been done. Now, there may be time in this phase for renegotiation and refining of terms as a result of the due diligence, and it can also be a stage where you can find additional value as well, such as in adjustments to the purchase price for cash, debt and working capital, those areas which John flagged earlier during valuation. The legal process also runs parallel to due diligence and is similarly intensive. So this again, why this stage of the transaction is really resource intensive for the principles of the transaction. So the SPA is the key document, and preparing this contract should be a case of papering a deal. So taking those already agreed terms and putting them into the legal document. And then also including any subsequent negotiations. So once the legals have been prepared, the deal can then complete. So this is the moment that everybody has been working towards, and everything that you have been building has then, and the value can then be realised. So as a seller, you would receive some or all of the proceeds at this point, depending on the structure of the transaction. So thereby realising all the value that's been built up in the business. Now, two elements which can impact the timing of when the proceeds will be received and when that value will be realised. And these are deferred consideration and earnouts, which John mentioned earlier. So deferred consideration, that's when an element of the proceeds is paid over at a later date. So there's no question over the amount, it's just the timing of when that's received. So it may be in 1 year or over a couple of years after completion. So earnouts or contingent consideration is slightly different. This is where a portion of the value is paid after completion, but it's dependent on certain criteria being met. So this criteria can be tailored to the exact circumstances of the business, and it's designed to allow the seller to receive a higher value over a period of time. So it does make it more difficult for sellers looking to exit after completion, as earnouts often require sort of continued involvement over time. So earnouts are increasingly common in transactions, and so it's definitely worth bearing this in mind when you're considering the timing of a future sale and planning for that. Now going to hand back to John. So that was just a quick whistle-stop through of process. So back to you, John.
Thank you, Tabitha. It's always great to think about that final celebration, isn't it, when you get to completion? But it's good to make sure that we don't forget the fact that there can be an earn-out and money still to come, and because that's the way sometimes that you get them maximise the value in the transaction. So thank you for that, Tabitha. Let's ask for another poll now, so we come to the next slide. We have another poll question for you this morning, so we want to make sure you're all still awake. And the question this time is, so this morning, before you came to the webinar and now you've kind of had some of the input, the question is, what aspect of selling your business is the area that you're most concerned about? And we just kind of want to see what responses we get across the room. So again, we'll just give you 30 seconds or so just to kind of respond to this, just to see where people are. Just give it a couple more minutes or a couple more seconds. Okay. So at the moment, interestingly enough, the area that's coming out top so far is finding the right buyer, closely followed by valuation. Can we just publish the result, please? Okay. So finding the right buyer, followed by the valuation point, which is helpful to us this morning. If we could close the poll, please. Okay, if we could come to the next slide. So interesting enough, we're challenging you this morning as to, are you thinking far enough ahead? And we've highlighted a number of different areas to you and are highlighting to you that it's really important to be prepared. Now, what happens if you get that unexpected approach, that unexpected offer? The question for you this morning is, are you ready? What planning do you need to start to implement? And we want to just challenge everybody. So we are publishing, as we said earlier, a white paper today that is selling your business and are you thinking far enough ahead? And we'll give you the details of that as we come to the end of the webinar. And it does include that business optimization checklist that will help you to start thinking ahead. And hopefully, as you've learned this morning, the due diligence process is at intensive period, and anything that you can do in advance to make sure that you're already running a very efficient business in terms of the paperwork, the planning, all of the different areas that we've talked about is going to leave you in very good stead. So just to pick up on why work with Menzies, if you come to the next slide. Obviously, we are a corporate finance advisor. We focus on transactions. Our sweet spot is 3 million to 75 million. And we have extensive experience across the whole market in terms of mergers and acquisitions, MBOs, funding and due diligence across our corporate finance team. It's a dedicated partner and director-led team. And the key thing for us, as we've been highlighting this morning, is to make sure that we understand the client's objectives. In helping them to achieve their objectives, we will then work with them over the period to bring them to the point of that completion and receiving the proceeds. We have breadth of experience both in the UK and international, selling businesses to overseas buyers, buying businesses from overseas businesses as well, and working with private equity. So that's our range of experience. We come to the next slide. Now, there's a whole raft of different considerations that we've covered off this morning that we've started to think about. And what we want to do is just to assure you that we're here to help you to navigate through that process and to help you to prepare. And the white paper that we're launching today will provide you with additional details and provide you with more information than we've shared this morning on the webinar. Remember that it's all about finding the buyer. It's all about maximizing the price. It's all about making sure that you don't leave any value on the table as you go through the process. So to summarize, as we come to our last slide here, before we move towards questions, the key thing to remember is to develop a strategic plan, to know where you're headed, to think about what you're looking to achieve and to have a plan to make sure you achieve it. Speak to us early. We can help you. Focus on those key value drivers. We can help you, and across our advisory team as well, they can help you to focus on that value equation and help you to increase the value of your business. But remember, the key lesson this morning is that preparation is the key to the value and to driving out value from your business. Come to the next slide. The white paper that we are launching today is Selling Your Business. Are you thinking far enough ahead? And the copies are available from our website. And everyone that's attended this morning will be receiving an email as well with a link to the website. And those of you that have viewed this on our website later, please, you're welcome also to download the white paper this morning too. So then if we come to our next slide, we just wanted to give you all time this morning for questions. So we'll just ask if you have any questions, and you'll find there's a question box at the bottom of your screens for you to be able to provide us with questions. And we've got some questions coming in already, which is good. So Tabitha, I've got a question here actually. Not everybody can see this one, but it says, I've had an approach which I'm interested in pursuing further. What should I do first? I'll let you pick up that one for us.
So the key to this is to really try and understand the offer and the assumptions behind the offer. So take time to consider what it is that you want from the transaction. That would be sort of my first thing to do.
And then it's collating information, isn't it? And spending time making sure that you're starting to collate information.
Exactly, and building that sort of data library.
Yes. Now, the next question we've got on the screen is, how does your approach change between different sectors? I think the key thing here is making sure that we understand what the key drivers are in any given sector, so that when we come to present the business, we're presenting it from the key strengths perspective of the business. Now, that could be intellectual property, it could be plant and equipment that's really important, or processes that are important to the business, or indeed it could be key customers that are important to the business. So it's about understanding what are the crown jewels in any particular business. And in terms of the approach itself, the typical approach that we've outlined this morning is the one that's most often used for SMEs in that deal size that we've been talking about. But it is possible, obviously, to go through a process whereby you use a data room more extensively during the process to actually get people to bid in, but that takes a lot more preparation and applies usually to bigger businesses. Then we've got the question, what due diligence should you do on potential buyers? I think the key thing is, if you're actually approaching buyers, Tabitha highlighted it for us earlier, the key thing is making sure that they're credible. Now, what we would do in working with clients is just think about the balance sheet of that business, whether they've got a track record in making previous acquisitions, and we'd be thinking about things like that first before we even make an approach to them. And that should help us to be able to work that out. If you have a particular concern, or the structure of the deal is weighted heavily towards deferred consideration, then potentially, yes, you could end up doing more diligence on the target. But in general, you'd be going to somebody that you've already filtered to ensure that they're credible. Tabitha, I think we've got another one here that people can't see. We've budgeted for growth next year. What should we do to document our strategy and growth prospects? Maybe you could pick up that one for me.
Sure. So ideally having an integrated forecast, which includes profit and loss, balance sheet and cash flow. And generally these sort of suggest these cover a 3-year time period, and then also document all the assumptions that sit behind that forecast and what steps are needed to achieve it.
Very good. Yeah, absolutely. The forecast, kind of building that forecast model on an integrated basis, is absolutely going to help you to pause and reflect on everything across the whole of the business. So that's really helpful. Thanks, Tabitha. So the last question we've got here, in the context of selling a software business, is there a tax difference in the UK from the perspective of an asset sale or a company sale? I think the key thing to remember here is that the most important element of this is, what do you want to do with the sale proceeds once you've sold your shares in the business? If you're selling shares, the proceeds come into your hands. If you're selling assets, then the proceeds obviously stay within the company. And therefore, there is tax planning to do to think about what you're going to do with the funds next, and whether you still want to take them from the company. Now, 9 times out of 10, we tend to recommend to our clients that they should be seeking to sell shares, because it is much more straightforward and easier for them to be able to obtain the business asset disposal relief, etc., that goes along with selling shares. But selling assets does not have to be a barrier. It's about thinking about what you want to do next with the proceeds and how it all works, and taking some advice. Very good. So we just want to say thank you to everybody for joining us this morning. We trust that you found that helpful. We will be emailing everybody that's attending this webinar this morning with the link to the white paper. It's being launched today. It's got the business optimization checklist in it as well, which will be a great help to people. Thank you very much.
Thank you.